ask your investors and say, hey, John, I understand you chose me because you like and know and trust me, and I'm a good communicator and I do great due diligence and I find these meaty deals and they're awesome. But what are you trying to accomplish? Where are you trying to get to? And you're going to learn that these avatars have destinations. And if you can speak to the destination, then you can show them that you are the person that's going to get them there.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Hi, everybody. Welcome to today's Capital Raising Show. I'm your host, Tim Mai. And today I have a very special guest, absolutely amazing, and his growth, phenomenal. And so I'm super excited. His name is Ryan Gibson. He is the CIO and co-founder of Spartan Investment Group. As the president of the company, he has organized over $200 million of private equity for Spartan's projects. Ryan has experience managing and developing of 6 projects in challenging markets. And for SIG, Ryan is responsible for investor relations and capital raises for the projects. Ryan's also a highly experienced commercial airline pilot. Wow, that's pretty cool. Ryan graduated from Mercyhurst University with a bachelor degree in business with concentration in marketing, management, and advertising. And here's some stats, guys. At Spartan, they have currently over $600 million asset under management, primarily self-storage, 4 million square feet, 30,000 plus units, and also some RV parks and a few other asset types. And Ryan has personally raised over $300 million. That's a huge number, Ryan. That's a lot of money to raise.
A lot of work, a lot of conversations.
Yeah, just out of curiosity.
Very good. Thanks for having me, Tim, and I appreciate your enthusiasm and your excitement. It's pretty cool that you put together a group and share information with others. So thanks for having me.
Thank you. Yeah, definitely. Thanks for being here. Just real quick before we get into a little bit of your history, I'm curious, how long did it take that to raise that $300 million? In what time frame is that?
Yeah, so our first syndication was in the winter of 2015, actually. So what is that? 8 years, I guess. Yeah.
Okay. That's phenomenal. That's phenomenal. Yeah. So share with us a little bit about your background. How did you get started in this syndication space?
Yeah. So I was an airline pilot, as you mentioned, and wasn't really doing a whole lot in real estate, but at the time, I was born with an entrepreneurial spirit, wanting to always getting to start my own business or do something, but never really knowing what it was. And, kind of started off doing real estate crash pads, which is pilot housing around airports for those that live out of base and need a place to stay when they commute in. And, that was okay. And did the whole cash flow quadrant thing where I did a stint as a consultant for the FAA, and I did the W-2 thing where I worked for the airlines, kind of always trading time for money, or thinking I had a business when really I just had self-employment and paying the big tax. And so I always wanted something more, working longer hours and things like that to kind of really make my money work for me. And luckily, one day I was in Washington, D.C., where I was lived for about 10 years. I'm also now out in Seattle. I heard there's some Seattle folks, Federico and Depp. So hello from Seattle. I'm over in Westlake right now at our office. And, I was really just kind of focused on getting the house next door to me sold, and met my business partner actually through that way. Started flipping houses in DC, started building new construction, condos, converting buildings. And that was a lot of work and, but a lot of fun and learned a lot. But really from there, we had pivoted into self-storage and wanted to grow a company based on that platform. So we do the whole thing now. We own a construction company that builds all of our facilities, and then we have a property management company that does all the property and asset management under our Free Up Storage national brand that we started. So that's really kind of how I got into it. I actually only recently kind of retired from flying last year. Being an airline pilot is a pretty good gig, and it's pretty flexible on when you can work and when you can be scheduled to fly. So I actually took the time to, do both for a really long time. but it just got to be too much last summer. So I kind of sunsetted that endeavor. But here today, we've got 128 employees now. We have an
Wow.
office here in Seattle. Yeah, and office here in Seattle, office in Golden, Colorado. That's kind of our headquarters, and we're focused 100% on storage and continue to raise money for those funds. So
Oh, that's
yeah.
phenomenal. I'm curious, out of all the different asset types out there, why storage?
Yeah, great question, Tim. Easy to own, easy to evict, easy to maintain. And if you look at the track record of self-storage against all other major asset classes for the last 28 years, it has outperformed everything. It's outperformed multifamily, it's outperformed office, it's outperformed retail, medical office, industrial, et cetera. And the thing is that, you know, it's also been the best performing asset class among major asset classes for the past 2 years. So the last 2 economic downturns, it was the best performing asset class. So, you know, we really liked that it was uncorrelated with the market. And I can
Mhm.
kind of get into the reasons why it's that way, but it really doesn't matter how good or bad the economy is doing. Self-storage tends to thrive and has been recession resistant. So I love that, because we were flipping houses and building things, and you know, it's kind of like you're always on like a 9-month cycle where you hope the market is going to be correct when you go to sell. And you know, there's ups and downs, and it really depends on everything that's going on. Where self-storage, you could have a lot of disruption in the economy and you could still have a lot of move-in, a lot of good occupancy. You could have a lot of boom in the economy and you have a lot of move-ins and occupancy. So we wanted to get rid of that kind of cyclical nature of markets and be in something that was a little bit more recession resistant.
That's phenomenal. And I would like to focus a lot of our topic today around marketing and how you raise, you know, the $300 million you raised. Has you found it? I mean, have you raised money for other asset types besides self-storage?
Yeah. So our first syndication was a condo development in Washington, D.C. And then we did a couple of single family syndications, really small raises, like 150 grand. And we've also syndicated for RV parks, 2 RV parks in West Texas that we still own today. We actually built a mobile home park in the state of Washington, about 217 pad mobile home park. We built it and sold it a couple of years ago. We syndicated for that. And I'm trying to think if there's anything else that we've syndicated for. That's pretty much it. Now we're solely focused on self-storage. A lot of the other asset types that we have, like we have some industrial, light industrial, some office, retail, et cetera. That's just because it came with like a self-storage portfolio that we picked up. Where there's even a little chicken wings restaurant in there down in Florida.
Wow.
So a lot of random stuff in that portfolio, but ancillary to what our primary storage business is. So
Right.
yeah.
Is it any easier to raise money for self-storage? Do you have to educate the investors a little bit more than you would, say, multifamily?
I think the big question people always have is, you know, why, you know, they're in multifamily, maybe they're heavy in multifamily, they've got 20 or 30 syndications, and they say, you know, I really want to diversify, and storage seems like a good next thing to kind of diversify into. So yeah, there's an education there. I think probably the biggest thing that people go is like, I don't get it, you know. I've never used self-storage. I don't understand why people use self-storage. So I always ask the group, I can't see everybody, but you know, who here on the call has used self-storage? Anybody ever use self-storage? Tim, have you used self-storage?
I've used it once, short
Once. Okay.
term. Yeah.
So we'll do this, Tim. What'd you use it for?
It was a transition move. Yeah, from one house to the next. Yeah.
Yeah, and why were you moving?
Well, we were down. This is 2008 market. We were downsizing. Yeah.
There you go. A great kind of grand slam. Not to put you on the spot personally, but everybody has used self-storage, mostly not because, you know, notice what Tim didn't say, which is he didn't say I had too much stuff and I was expanding and things like that, right? So a lot of people think like, you know, oh, well, self-storage is just this overinflated American thing that people have too much stuff. And I always say it's not. It part of that is true. I'm not gonna say it's not true, but you know, people use it for life events. When things happen in the economy, like people downsize, they relocate, they expand their family, they expand their house, they have to use self-storage. So that's why it thrives during good times and bad. So, you know, during the pandemic, we saw an absolute boom in self-storage because a lot of Americans, in particular, were moving. They were they had that extra room in their house, and now they had to turn into a podcast studio, or they had to turn into a home office, or they had to free up a room to start working out, or they had to, they said, hey, screw this, I'm selling my house and I'm hitting the road in my RV for the next year, and I'm going to live and work on the road. And or maybe it's like you realize this house kind of needs a renovation, so I'm going to move my stuff out, which is what I did. And I moved my stuff into self-storage. And then there's a lot of personal use. I see the 9 motorcycles in the chat, and boats and things like that. That's another reason. And then 30% of our customers are all business owners. They're Etsy, Amazon stores, Chamber of Commerce, pubs, offices, things that have to downsize and upsize on a regular basis. So it's a really uncorrelated asset class based on what the market's doing. And I think that's why it's been so successful for so long. And, so I think a lot of people that come over, they kind of learn what it really is. And it's not just some, Marie Kondo, tidying out Marie Kondo show where Americans just can't get rid of their things. People have a proclivity to not want to get rid of their stuff, but it's really just a life event stuff. So it's very, very good. So.
Right. So what would you say, has been like the most successful marketing channel for you when it comes to capital raising?
Yeah, I would say working on your existing list and satisfying your current investors are really the best marketing channel. Like, the best marketing you can do is the marketing that you do is the service you provide to your existing investors. And that's been a consistent theme of ours for years. And now you can't make everybody happy. Sometimes deals don't go well, and sometimes deals don't go well as you project, but you have the opportunity to communicate with your investors. We do communications on a monthly basis. So we send out every month on the 1st, come hell or high water, we have a communication that goes out. Doesn't matter what's going on in your life. I don't care how busy you are. I don't care what's going on. 1st of the month, every month for the last 8 years, I've delivered a communication on the 1st of every month. I can't guarantee returns, but I can guarantee you that I'll have a communication to you on the 1st of the month. And we have expanded our transparency in what we share. So we actually post full financials every single month. So we do full trailing 12 financials. We do a little summary of the project. We roll it up into an investor statement. And then we have pictures of the property if there's a construction element or something that we've done to improve it to show progress. That breeds trust, and not every investor is going to sit there and read all your updates. That's not the point. The point is a little touch point to let your investors know that the heart's beating and that you're fogging up the mirror still, and that you've got, you're paying attention to the project is really, really critical. The second thing is, most of our investors come from referrals. I mean, we have investors that have invested in 90+% of our projects, and then they have a good experience and they tell other people. And I would say we get more, you're going to spend a lot of money trying to market and trying to find new investors, take care of the ones that you have. And so, and ask them, spend time with them. Don't be so robotic in a survey or something, but go sit down with them and have a beer and talk about other things. But, get into, hey, what am I doing that, how is my communication? Shoot me straight, and be open and curious as to like the feedback, really listen to what they have to say. Some of my best ideas for communication came from those conversations where it's like, when you open up my email, what do you want to know? And, one investor told me something that I thought was really powerful. And this is just a 50K investor. He said, I just want to know in 20 seconds or less if we're on target or not, and why. And so we started doing quarterly reporting on our pro forma versus actual. So you can look at our pro forma versus actual and know immediately, are we above, are we below? And then you should expect a reason if we're below that. So I think investor communications is critical. And then property tours have been a massive windfall for raising capital. It may not feel like it when you're there, but it's a really big deal to bring a bunch of investors to one of the properties that you own and walk them through and put their arms around, something that they're actually investing in. I think that's really powerful. It's difficult sometimes to get everybody into the right markets. I mean, we're in a lot of bedroom communities surrounding major metroplexes, but if you can get investors to your property, there's a high likelihood that they're going to convert and invest.
Gotcha.
Yeah.
And for the investor communications, do you do all of it on email, or do you also send out physical newsletters as well?
Yeah, so we do the updates themselves are just emails and posts to the dashboard. So we do a PDF. Happy to share our updates with you guys as an example. But they go to our dashboard. So like one thing we've learned over the years is people get a lot of emails, kind of get lost in the sauce, and then they go to spam or something, right? And
Right.
and you might have that investor who's like they're not paying any attention to what's going on. So you're like, man, I'm doing a great job communicating, right? And you're sending out all these emails. And then like once a year, they might be like, what's going on with that deal that I did with Ryan and Spartan? So they'll like log into their dashboard and there's nothing there. Right. And then they're like, whoa, what's going on? Why isn't, da, 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 da. And right. And then they've got none of the emails, and then they email you and they're all mad and upset because it's like, hey, I haven't been getting your emails, or I haven't heard anything about this deal. And you're like, whoa, whoa, whoa. We've been sending you a communication every month, and they may have not received it. Right. So I highly encourage, if you do have an investor dashboard, put the communication on there as well, so that they can also go in there and see the latest update. Because you're going to have that one investor who just doesn't read their emails, right? Or Gmail's marked them as spam and put them in some other place, right? So, so I would do that, definitely.
Great. Yeah, that's a great suggestion.
Yeah.
So a lot of like it seems like you focus in and nurture your existing investors a lot. What about new ones? How do you get them, into your funnel to begin with?
Yeah, I mean, you guys, I'm probably not going to say anything mind blowing here. We do a printed monthly newsletter that gets mailed out to our investors every month. That might not be for the new investor syndicator that's looking to build their list, but we do a printed newsletter. I think that's coming back. I think that's powerful. We go to conferences. We speak at conferences. We get on people's podcasts. We get our name out there. We host educational webinars. We host a meetup every single month at our office. We ask for referrals. It's funny. I know you guys are probably nervous about asking for referrals, but it was interesting. In interview your investors, we actually templatize some questions that we ask our investors, and we ask investors if they'd be willing to be interviewed. And it's amazing what you learn about your investors when you do that. You may think you know somebody, but you ask them some pretty open-ended questions. And we had an interview with one of our investors, and he said to me, Ryan, you've done exactly what you said you're going to do for me, and you haven't even asked me for a referral. You should be demanding that I give you my Rolodex. And it was funny because he was trying to like kind of push. He's one of our vendors actually, but he invested a pretty significant amount. And and he said, Ryan, you haven't even asked me for a referral. You said you're going to communicate. You've been communicating. You said you're going to have distributions at this, in this range. You've been doing that. You're showing up. You're doing exactly what you said, and it's been a year. And you haven't even asked me for anybody. And it's interesting. He goes, Ryan, I run in a rich person's circle. I know other business owners who are more or equally as successful as me, and that's who I hang out with. And you know what we like to do? We like to tell each other who we're investing with, as like a badge of pride. And he's like, I want to give you people, right? So he's like, you got to be asking. So I think. There's an art in kind of how you do it and when you do it and things like that, but just ask for referrals. It's huge what you can get out of that. So, put it in your monthly newsletter. Hey, we're looking for some more investors. If you know anybody, click here. We'll make it worth your time. And when they do that, guys, what are you going to do? What are you going to do when somebody gives you a referral? What are you going to do, Tim? I'll put you on the spot.
Well,
What are you
that
gonna
way
do?
you thank them, and maybe even send them a gift of some kind.
There you go. Exactly. Like so it's like stop, drop, and roll in the office when you get a referral. It's like they're getting a handwritten note, that day, going in the mail. They're going to get maybe a little gift. We have mugs and shirts and vests and things like that. They're going to hear from, even if it's just a handwritten note, guys, it costs $1. Right. And 35 seconds of your time. How many people are doing the handwritten notes right now? Nobody's doing that. Let me tell you a story. There was an investor, anybody who invests over 200,000 with us gets a handwritten note from our CEO, Scott Lewis, my business partner. Let me tell you the power of that. Like who here on the call is doing handwritten notes? Anybody doing be honest. I mean, is anybody doing handwritten notes? Guys, it's an open market. It's an open market. Nobody's doing it. So I got this guy, he's in his 60s, and he put in 1.5 in our deal. And Scott sends him a handwritten note, and he writes us and says, hey, I want to meet Ryan for lunch. So we go down, and he has his binder. He wants to talk to me, and he pulls his handwritten note out and he's waving it around in my face. And he's like, no one does this anymore. He's like, I'm in for another 1.5 million.
Nice.
Right. And it's like, it's amazing. And what did that cost us? Nothing. A dollar and a couple minutes of your time. So I would really be focused on being so appreciative. Like, guys, the lifetime value of an investor to you as your business is massive. And if you're not appreciating that and doing things that are unexpected, you're missing out, because I think it's really powerful to do something like that. Even though it's basic, it's just old school stuff, right?
Right.
But no one takes that time anymore. We all want to just keep firing emails out of our CRMs and, endless emails. And it's just new. Like, everybody does that, right? So do things that people aren't doing.
That's
Yeah.
good. That's really, really good tip. Your meetup, has that been very successful for you? How many people do you get to the event?
The speakers have been fantastic. I mean, we've flown people in, and we've had really, really good content. But man, I don't know if it's the time of the week or what, but it's been a little bit lackluster, to be honest.
Mm,
We definitely have converted. Investors come in, they've never invested with us, they get to know us more. I think just the notion that we have it is good, but I'm not, we don't have hundreds and hundreds of people that are coming to these things. I would say, 20 to 50 would be the attendance. But we do record what we do, and we put it out on YouTube and Zoom, so it gets a little bit more traction. But hasn't quite been the windfall that I expected, and maybe it's because it's during the day. We're thinking about switching it to at night, so like
gotcha.
midweek and at night. Yeah.
Okay. Well, who's your avatar? Who do you primarily go after?
3 avatars. Professional services, Simon. That's your doctor, lawyer, airline pilot, tech guy. They're working long hours. They're working 90, 70, 90 hours a week. They want to convert active income into passive income. There's nobody on this call that doesn't know that avatar. That's an avatar, right? That's, your typical investor. But just keep in mind, like, they care about education. They find you on a podcast. They're learning, right? Like an airline pilot or a doctor, they're masters of their craft. They're very good at what they do. But they don't know anything about investing. So they get into investing and they want to get educated, right? So they're hungry for education. So that's why you see a lot of syndicators put out content about education and things like that. Then we have what we call CEO Charles. CEO Charles is your C-suiter. They're a CIO, a CFO, CEO, VP at a large company, and they're making, $5-10 million a year potentially. They've got great stock package, right? They don't got time for any of your crap. They don't care about learning about, what you're doing. They're finding you in like RIA magazines and, real asset magazines, stuff like that. And they know a little bit about self-storage. They've heard about it, but really they're going to write you a big check, but they're not going to read any of your updates. And when they do call you, they expect an immediate response. Like, hey, Ryan, what's going on? And they hit them direct, man. They don't got time to screw around. They're running a company or doing something, right? They're working for a company, but they're running it, right? So that's the second avatar. Third avatar is your it's your person who owns a cash business. So like a service-based business, like a PR firm, marketing firm, a law firm that brings in a lot of cash, but they don't have assets. So they're trying to take cash, turn that cash into assets. These companies these business owners are making decisions on placing capital, usually at the midpoint to the end of the year, because they're doing their cash and budgeting. It's a good time to hit them up at that point. And their concern is like their business is really good, but it could be really bad overnight and be value less.
Mm-hmm.
So they're trying to put money into hard assets. So that would be, probably the other one. And mixed into that avatar are people who already invest in real estate. I mean, how many of you guys know, your investors probably did, their own single family flips or multifamily, et cetera. So they're kind of like business owners and they understand that space. And those people might be a little bit more interested in learning about what you do, maybe to the lesser extent than the services person, but way more than the CEO person. And the CEO people, I saw a question there. How do you approach them? They want to do They want to do things that if you break down our list and you see where the money comes from, volume wise, can anybody guess where the money comes from? Like from a head count, like if you look at our 1,000 or so active investments, the most investors are going to be your pro services, Simon, your doctor, lawyer, tech guy,
Right.
like 100%. But can anybody guess where the most money comes from? CEO Charles. So there's few of them, right? So there's fewer of them, but they write bigger checks. So it's interesting that everybody, we all spend our time. I see everybody catering to the pro services, Simon, the doctor, the lawyer, the airline pilot, the tech, the engineer person, but the biggest checks come from CEO people, bar none. And those referrals are massive because who does a CEO know? Another CEO.
Yep.
Right. So I would really like just something to think about as far as approaching them. I don't know quite, you could clarify that question, but just kind of knowing where they hang out and knowing where they're reading content. They're not listening to your podcast. They're not here on this podcast. They don't care. They don't have time. So, getting into a better position to get in front of those people is worthwhile. So.
Yeah. So give us an example of a good place that we would find them.
Car shows, cars and coffee. When you think about, they're going to see you in a well publicized magazine. Like, I can't remember, it's skipping my name right now, but there's like not an RIA magazine, but like a business journal, right? They're going to read about something there. They're going to see you there. They're not on Bigger Pockets. They're not downloading iTunes and looking up cash flow connection. They're not doing stuff like that. Right.
Right.
So just it's a different avatar that you want to go after. So
very interesting.
Yeah, exactly.
Okay.
Golf out. Exactly. Someone said golf, sailing, rowing, flying, things like that. I like to call them like accidental meetings, right? Like you're going to be off doing like I joined a running club, right? Not because I was looking for investors, because I wanted to run. And like, that's where you meet these types of people, right? So there's a lot of different venues for CEO Charles. Yeah. Snow skiing. Exactly. You guys got it. See, you don't need me.
Awesome.
Yeah.
Awesome. Just
kind of clarifying where you're going to meet people like that. So.
Right. Do you do any targeted marketing for any of these avatar, like an actual marketing campaign that you do ongoingly?
Sure. It's less about target marketing too. And well, it's just about target marketing, but it's also about messaging, right? Like, they want to receive, they're going to hear a different message than, are you sick of working long hours and, and this and that, and you want to change your active income into passive income? Not real. Like that's not really what they're trying to do. They're in a high demanding position and they make a lot of money. It's either they're doing that or they're not doing that. It's not like, they're a pilot or a lawyer and they can scale back their billable hours because they've now got passive cash flow. So it's just a different messaging, right? So not only do you want to be in the right place, but you want to have the right message. And so we could talk for hours about that. So.
Well, that's cool. In terms of, so when you mention, you go after all three of these avatar type, do you like, because I'm trying to get a picture of what your marketing for these passive investors look like. Can you give us sort of an insight into that?
Yeah. So we break them up on our list. So we categorize them and then we send specific messaging to those investors.
Okay.
So, and the other thing that we've done is we've offered 3 funds this year, which has been helpful for, I'll give you a great example. So you have a lot of one-on-ones with your investors. At least I do. I have a lot of meetings and just happenstance, getting together. And, one recent investor is a surgeon and he doesn't know anything about this. He just kind of getting into it. And he said, hey, he's like, what, you guys have 3 funds, which ones do you think is, how does this work? Instead of talking about, you know, well, we got this fund and this is this and this is that. I just said, you know what? I'm just thinking in my head, you're a doctor. You've expressed that you're trying to reduce your hours and increase your passive income. I'm going to talk about our income fund, which is targeted at those investors who are trying to convert active income into passive income. And so he was like, oh, that sounds great. Right. And you don't even have to talk about the other funds. Right. So it's like, you got to know who you're on. And, you guys have all heard of Simon Sinek, finding your why and all that stuff. Ask your investors not why they chose to invest with you, but what they're trying to get out of investing altogether. It's really critical, right? I can sit here, I could give you all kinds of examples, but ask your you need to go on this learning journey yourself. Like, ask your investors and say, hey, John, I understand you chose me because you like and know and trust me, and I'm a good communicator and I do great due diligence and I find these meaty deals and they're awesome. But what are you trying to accomplish? Where are you trying to get to? And you're going to learn that these avatars have destinations. And if you can speak to the destination, then you can show them that you are the person that's going to get them there. So, I keep hanging on the example of active income and passive income. It's like, hey, you don't want to do my growth fund, Mr. Doctor, because I know you're trying to get passive income. So this growth fund doesn't have any cash flow in it. It's all upside, right? It's all ground up development. I know you're not going to want to be in that space because you're trying to get cash flow, right? And so if you're messaging that to an investor, it's important to want to know the destination of like where they're trying to get to so that you can tailor your messaging to your investors, right? You might have a network of nothing but pro services, Simon. So anyway, that's just kind of one example of, just getting your messaging right and understanding what your investors are trying to get. Cause that is sales 101, right? Sales 101 is you're a problem solver. You're trying to listen, identify the problem that the person has and solve it. And then the other thing about sales, I think sales is two-pronged. It's that, and it's also conveying to the person you're trying to sell something to that they have a problem that they didn't realize they had, right? Like maybe recognizing that, hey, you're paying a lot of taxes, maybe you should start, focusing on passive income versus having all of your money that flows into your income, your household be active, right? How can you get to portfolio income or active income? So
that's good.
Anyway, yeah,
that's awesome. And then, so as as the investor relations person in the company, do you try to get on or intentionally try to get on a lot of podcasts, a lot of like stages, things like that?
Yeah, I think it's important to get your name out there. 100%. I mean, I'm going to butcher this, but I'm going to try it. So it's it's called the 7-11-4 rule, I think is what it's called. I'm sorry, guys. It's not going to be mind blowing, but it's like, you have to be 7 different outlets of media, 11 different touch points, 4 different venues, something like that. So you have, you're doing your social media, your email advertising, your LinkedIn advertising, you're on stage, you're, doing a drip campaign, you're doing a text message, whatever. Like you have seven ways of like getting your name out there, 11 touch points, and then, 4 venues. So it's like, I saw you speak at Best Ever Conference. Then I saw you on Tim's, Hero Capital Raising podcast. And then I saw you at John's meetup. And then we met for coffee at lunch, right? Or met for lunch. And I think people want to see you in those different venues. So the more you can sort of corner a market or corner where you show up, I think is very validating to who you are as a person. And I think that's really impactful. So
that's really good.
Yeah. Is that helpful?
Yeah.
So
yeah.
Just on your marketing strategy, think about like, why am I going to this conference? Well, I might see somebody or someone might see me that they saw me in a different venue, and that just helps shape the whole person for who you are, because people want to know you. They want to know you, they like you and trust you, right? So I always say there's kind of there's three things that an investor wants to know, or three things that really I know I'm going to convert an investor on. Know, like, and trust, obviously, like everybody knows that. That's like one of the things. But they get to know you, then they know real estate. That's the second thing. And then they like the market that you're in. If those three things line up, you're going to have a conversion, right? Because they know who you are, they know the operator, they know real estate, and they know the market. I think those are really three key things. So when you're thinking about building your brand and your business, think about how can you position yourself for those three things to get met. So if somebody has nothing to do with real estate, they can come into your ecosystem, they can learn all about real estate from you, they can get to know you, maybe through you teaching it, and then they like the market that you're investing in. So how can you get them to like the market? You can talk about it. You can educate them on the market that you're investing in, right? So a
That's
lot
good.
of different ways to do it. Yeah.
That's awesome. In terms of touch points, do you try to get everybody or as many people on the phone as possible, or do you focus more on automation and then less people on the phone? How do you balance that?
Yeah. Yes. I mean, who wants a phone call these days? Not very many people. Some people do. Some people want to talk, and that's good. So I would say it's a combination of all the above. Sometimes, like, if you called me, I'd be annoyed because my day is 100% scheduled. Like every minute, every hour, it's scheduled. So I don't have time to just talk to you, right? So I want a text message and I want an email, and I want to be, sometimes I kind of want to be harassed a little bit because I won't respond, right? I'll forget, right? So I do think follow-up is important, but everybody's a little bit different. So we use HubSpot. I see that in there. So we use HubSpot, and Salesforce is kind of our main platform. So
That's awesome. Well, let's talk about.
We did the droplet, the ringless voicemail. Please stop doing that, guys. It's annoying. Everybody's doing it. It's spammy. And Jesus Christ, hold on. How many voicemails do I have in here that I haven't looked at? Here, I'll show you, like, in real time. Maybe you can't see it.
Yeah.
98 unread voicemails. So no, it's basically the voicemails is like a spam box. I don't know. Maybe have somebody more insight into that, or more success than I have. Maybe it works for wholesaling or whatever, but for investors, I'm not checking my voicemail. So anyway.
Good to know. So besides HubSpot, what are some of your other software that you use in the business that you like a lot?
Yeah, that we like. I mean, I like Salesforce. It's expensive. It's hard to use. It's, the analogy is like, it's like buying a Lamborghini you don't know how to drive. It goes really, really fast if you know how to drive it and have had some pretty serious training. But you can do anything with Salesforce. You can connect it to anything. You can API it to anything. You can integrate it. I think it's a pretty awesome. It's the ultimate CRM platform. It's expensive, but if you get it to work, it works nice. I've used MailChimp. I've played around with Infusionsoft. They're all the same. They all have their little tweaks and nuances, and this one does this, but it doesn't do that. I think they're all pretty good. I mean, we used MailChimp for a long time. ActiveCampaign, like I say, Alex, I agree. Like, it's really just, whatever you pick, just pick something that works for you and just go deep on it and see all the things it can do, or hire somebody that knows what they're doing to do it. But I wouldn't say there's one way of doing it. And that's what's so cool, is like, there's so many different platforms and they're not very expensive. A lot of them are free if you have fewer than a certain number of users. I think we were on MailChimp for like 5 years and never got charged anything. And then I think they caught on to it at some point. But we were on Podio for a long time. That's an old thing. I don't know if anybody uses Podio anymore, but you can make Podio run like a Ferrari. And that thing is like, you know how to program it and stuff like that. You can make it do a lot of really cool stuff. But yeah, I mean, HubSpot, like you said, Alex, it's slightly better. I don't know. Is it better? Is it worse? I don't know. You could sit here and debate that for hours, but they're all pretty good. So, and it's really cool what they have. Like, I don't know if you guys have heard of Outreach. outreach.io. It's a really good like follow-up drip campaign kind of thing. That's another good one too. So yeah.
Awesome. What about portals? Which one do you use?
Yeah, so that's been kind of a sore spot. You know, Juniper, if I had to make a recommendation, I would do Invest Next. You know, just if your takeaway, I think Invest Next has got the superior product on the market right now. We were going to go with them. You know, love those guys, love the product, love where they're headed. I think they're a very strong system. We're currently on IMS, which was bought by RealPage. We were like an early adapter of you know, when all this investor management software came out, we were like one of the first ones to jump in. And so we've been on an IMS since like 2016. Like we were like the third or fourth customer. And it's a great program. Somebody spent a lot of time and money to build it out, and then it's sold to RealPage, and they haven't done anything with it in like 5 years. But even what they did, you know, 8 years ago or whatever, they built a pretty good program. But it doesn't. The problem with all these systems is they don't open an API. So they'll Zapier integrate, but you know how that works. It's clunky and it breaks, and you got to fix it, and it's delayed and stuff like that. So like a lot of these investor management softwares are closed-ended systems. So we're actually building a platform inside of Salesforce to really kind of drive our CRM, and then connects to our bank account, connects to our books, connects to all of our different systems that we're using. You know, HubSpot. We use TalkDesk to log calls and things like that. But yeah, InvestNext is great. If you're looking for something just real quick out of the box, that it's a no-brainer. So
Awesome. Thank you for that. In terms of, you know, syndication versus funds, have you found one to be easier to raise money for than the other?
You know, we're in the business of FOMO, right? Everybody knows that. You know, individual syndications, you can get FOMO because it's a small raise in one property and open and close, boom, right? Funds are less. It's hard to get FOMO out of funds because, you know, they're open for a while, they're massive, they're big, they don't own anything in the beginning, and then they maybe they do, I don't know, but and then they buy stuff, and you really got to, you know, work on, you know, what's the you know, incentive to do funds. So if you do funds, I would do some kind of a early in incentive. You know, if you invest in the first, you know, so many days or so many weeks, you know, you got to have something for your investors. I think adding value is really good there. As an operator and as an investor, I am only going to do funds because, you know, I could go into an example. Just a really quick example. Like last year, we bought 6 properties in our fund 1 for storage. The first property, you know, we got to the closing table, and you guys know how it is. It's like you got to have the right amount of equity. You got to have the right debt. You got to have, you know, you got to have the closing and the due diligence and the price and the interest rate and all that. It's all got to line up on like one day, right? And how hard is it to like, it's like a really pointy mountain, right? And you're trying to land a helicopter on that perfect, you know, and you know, you get to the closing table, and what happens? The lender backs out, or the lender changes terms, or you didn't raise quite enough equity, or you raised too much equity, or whatever, right? You're trying to like get this thing perfectly landed. And so syndications one off, I mean, they could fail, right? Like I know a lot of syndicators, especially right now, they get to the end, they get their money raised, or they don't, and they get to the end and they can't get the debt. So then the deal implodes, right? And that sucks because you raised all this money, and now you're pissing everybody off because you got to send all the money back, and everybody's just like, what's going on? Are you not the real deal? And all this. Anyway, it's kind of frustrating. Well, when we did a fund last year, first property we bought at 40% below market, 50% below market rent, screaming deal, awesome cash flow. But we didn't find the right lender by the time we closed. But because it was a fund, we had the $15 million in cash there to buy the asset. And guess what? Now all that money that was in the fund, all those funds got activated and they started cash flowing. So let's play this out. If that was a single deal, we would have got to the closing table and the lender would have failed. Now I'm emailing everybody, and I don't like the rate and terms that we got, and we're going to wait, and this is going to delay closing and all this other stuff. Meanwhile, the seller is probably going to walk, right, from this awesome deal we have. So fund is like, we just bought it all cash, and we're like, hey, we're going to take our time, give ourselves all this breathing room to refinance out at a later date. And so later on that year, we found a great interest rate, 5.5% fixed rate, refinanced the money, and bought another property all cash. So it's a really nice, you know, it streamlines your entire company. I've done 29 single syndications, and let me just tell you, like once you start stacking, like your first one or two, you're like, oh, this is easier to do single syndications. But man, when you have 29 different deals, 29 sets of books, 29 different tax returns, 29 different K1s for, sets of investors for each one, it really is a lot of work.
Mm.
And you're gonna make mistakes, and like you want to spend your time, doing that or doing something else. So the fund model, if you can pull it off, is really good. So.
Gotcha. Okay. And so, like, some of these benefits that you share here, I assume you also like educate your investors on these benefits as well, and how it would benefit them ultimately.
Yeah, if they're willing to listen. Some of, some of them, it's funny. I sat down with one last year, and he's like, "I'm not doing your fund." I'm like, "Okay." I'm like, "Can I ask why?" He's like, "Well, I just like the deal by deal stuff." And I was like, "Okay." Well, we did 10 syndications last year. Which ones didn't you do? He's like, "Well, I didn't do this one. I did all the other 9 though." I was like, "Well, why didn't you do that one?" He's like, "Well, I was on vacation. I missed the window and the deal filled up." I was like, "But would you have done that deal?" And he's like, "Yeah." I'm like, imagine just writing one check, because we're not buying anything different. It's not like we're going and buying a brothel. I mean, we're buying a self-storage property, like it's not like we're going and deciding to just completely go off record. We have to be specific in what we buy. You
Mm.
can't just go buy whatever you want. You have to, in these closed-ended, non-registered funds, you have to be specific in what you're going to purchase. You don't have to say like this address, this address, this address, but you have to say, 40,000 square foot facilities within secondary and tertiary markets, self-storage properties, right? We bought an RV park, it would not meet what we've defined in our offering, right? So, yeah, I mean, there's education. So like spread out risk, multiple market exposure, better financing terms, potentially overall higher returns to the investors. Yeah, let's share these information and educate your investors. But, some of them are going to be still slow to do the deal. So.
Right. That's good.
Yeah.
So perhaps, starting from scratch, go straight into a fund model so that way you already precondition all of your investors to be used to funds might be a good idea.
Yeah, there's a lot of different ways to market that, right? Like exactly, you could say like, "Hey, I'm launching a raise for this house, right? I'm going to syndicate this housing flip," and you can talk all about that house and how awesome it is, and you can tranche it. You can say, "Hey, we're raising $1 million for this house," and then like you can talk about it being full, and then use the same structure to do the next house, the next house, the next house. And you have to disclose all that, but you can market your fund in a way that positions it kind of like a deal,
Right.
but also in a fund model. So now there's limits on how long you can raise and keep the fund open, but that's a great way of kind of making it feel like the story behind the deal is still there. Yeah.
Right. That's good. So, where do you see the market going? Where's the opportunities?
I think multifamily. I think a lot of investors are sitting on floating rate debt. I think there's there's a lot of operators stopping their distributions because of their floating rate interest on their underlying portfolios. I think there's going to be a lot of loan covenants that are blown, and people that are in default of the loans. And depending on the lender, you're gonna they're either going to be willing to work with you or they're not, depending on who the lender is and what the relationship is. I think that's going to breed a lot of opportunities in multifamily over the next 12 to 24 months. Office is going to continue to be in peril, and retail is, I think you're going to see continued cap rate expansion and see opportunities in retail. I think big pharma and medical is going to be, really good. I think self-storage is going to be continuing to perform really well, just due to some of the disruptions in the economy. The Fed meets this week, right? Is it this week or next week? I can't remember, but I'm thinking a quarter point interest rate hike and maybe another 50 bips after that. But really, I mean, I think we're going to see the peak of interest rates over the next year or so. And then, I don't know if you guys follow the Chatham Financial, like the forward curve, everything is the forward curve is really kind of flattening, showing a decline in interest rates over, the end of 2024. But, I think transaction volume is coming to a screeching halt. A lot of people aren't selling, a lot of people aren't buying. But values haven't really collapsed all that much yet. And so, a lot less 1031 exchanges happening. Investors are careful about where they invest. There's a lot of capital calls going on right now. We don't have any capital calls, but so there's a lot of investors that are ponying up for that or just kind of shoring up cash for that. But yeah, that's my 2 cents on kind of where we're at. So
That's all.
yeah.
Thank you. Yeah.
Yeah.
What about, do you partner with other operators on deals?
No.
No.
Now we do offer, like, if somebody's a fund to fund or they're raising capital, we have a really great program for raising money for our deals, where we, give you a better promote, a better split, better returns. But outside of that, we don't partner on other deals. It's like not in our DNA. We've done it like once and it just wasn't a great experience. But we do take funds from other funds. So
Okay. So fund of funds, like, do you have a minimum that you would want?
there's no minimum. No, I mean, 50K is the minimum. And actually it's kind of interesting. The way we set up our funds this year, if you invest in the first 45 days, you get a bump. So a 50K investor with the benefit of $1 million investor, $1 million investor with the benefit of a $3 million investor. So that's better return split structuring. So a fund to fund can come in and fund to fund could raise 50 grand and still have a better economic value for putting together that fund than someone that comes into our front door. So we have a really good program for that. So
I like that. That's pretty cool. Do you hold on to these properties for as long as you can, or do you have a 5 to 7 year window that you flip them, or what?
Favorite question. So yeah, so investors want to see a 5-year hold, right? They want to see a bookend. They want to come in, they want to make money, they want to get out. We're going to do that. It's no problem. So everything's kind of 5-year hold. But at Spartan, we're building a portfolio. We're building a portfolio of self-storage assets and a company that's separate from Spartan called Free Up Storage. And that company needs self-storage facilities to manage and run. And so we're actually there's a number of different exit strategies that we have, which I think is really exciting. Typical, we can, sell a property to a buyer. We're doing that now. We're trimming some assets that we just don't really fit our portfolio composition. But we're setting up a DST fund. I don't know if you guys are familiar with those. So if investors want a 1031 exchange capital into a DST fund, we would sell one of our assets into that fund. And that's a way that we can maintain control of the asset and hold it into perpetuity. And then one of the exit strategies from the DST fund is we want to upreit in, via 721 exchange. So that 1031 investor can have shares and, break that up to their heirs simply and easily. So that's one strategy. Another strategy is we can swap out LP equity with institutional capital that maintains us as the manager of the asset. Or, there's been a lot of REITs that look at our portfolio and want to buy the whole thing or portions of, or break it up, et cetera. So a lot of different things, but long-term, we want to keep the high quality assets under our management and continue to build the Free Up brand.
Gotcha. When you said DST, is that the Delaware Statutory Trust?
Yes.
Gotcha. All right. Just, because I know there's another DST, the Deferred Sales Trust. And so
that sounds like a really interesting thing. It's a little bit mythical to me at this point. I don't not quite understand how that works, but DST is like, it's kind of been around. It's been around since 2004. Investor comes to you, says, "Hey, I want a 1031 exchange into your deal." We've done that. You can do it through a tenant in common. It's very complex. You can do it. There's a lot of hoops, and you probably are going to do it wrong. To be honest, we did our first one incorrectly. But the Delaware Statutory Trust is great because if you can set it up, then you can have those 1031 investors kind of pool together and own their pro rata ownership within that DST with identified properties. And it's a really great place to put 1031 investors who want to be passive in your deals. It's a little complex, but it's worthwhile if you get a lot of 1031 investors. And if you don't want to take those 1031 investors, send them on over to us. We'd be happy to take care of them. So
that's awesome. Yes. So with that, if the folks wants to reach out to you, connect with you, invest with you, fund, send their funds money over to you, where would you like to send them?
Yeah, if you go to our website, spartan-investors.com, and then my email is ryan@spartan-investors.com. You can catch me on LinkedIn or otherwise. So yeah.
Okay, yes. And we're going to be wrapping up this segment of today's interview. But before we do that, what is, what is the words of wisdom that you want to leave with all of these capital raisers on the call today?
Yeah, I would say, I know it's kind of, probably standard advice, but just, I can't stress the people part of it. Just don't waste your time with bad people. And, if you're starting a business and you're just using capital raising as a tool, go find the best person in your niche. So if you want to become a multifamily company or storage company or whatever, go out and hire the best possible person you can to run your brand, for storage or for multifamily or for office. Like, you can try to do it yourself and become an expert in there, but I think it's pretty limiting on how far you can go if you do that. And then you focus on being the visionary of your business.
Very good. Very good. All right. We're going to open up for Q&A just a little bit here, but I want to wrap up this interview. Thank you so much, Ryan, for doing this interview with me today. You've been a wealth of information and wisdom. Thank you so much.
You're welcome, Tim. Thanks.